Let's talk about the most recent PPI report that just dropped and what exactly that means for the economy. So starting off, we know that Trump has been pushing tariffs with the promise that other countries will foot the bill. Frankly, we know that that's not the case. We know that ultimately that burden falls on American corporations and consumers. And the latest inflation numbers that we just got tell a little bit more complicated story than just that. So what just happened? We had the producer price index, or the PPI, just jumped 0.9% in July and is up 3.3% over the past year. That is a measure of what businesses are paying for goods and services, and it's currently rising faster than what consumers are seeing on the shelf. Now, earlier this week, Consumer Price Index, which is CPI, showed a smaller 0.2% month-over-month increase. That was about 2.7% annually. So that suggests that households are not yet feeling major tariff-driven price hikes, except in certain areas like medical care, which are seeing those significant price hikes. So what that means is that companies are absorbing higher costs for now. They're not passing on to consumer yet, and that can only last for so long. So when we dig deeper into those numbers, the pressure becomes a little bit more clear. Both goods and services saw sharp price increases in July, 0.7% for goods and 1.1% for services. Business investment is also getting hit. Manufacturing equipment prices climbed 0.4% in just 1 month, while related services spiked by 4.5%. Even the raw materials and components that feed into production are getting more expensive, with durable manufacturing goods up 1.3% and components are up about 0.4%. So these costs are eating into company and corporate profit margins, meaning that less money is available for them to reinvest or for them to return to their shareholders. And that is one reason why Wall Street reacted negatively to the PPI report. That's why we saw the stock market kind of drop when that report dropped. Earlier consumer price data had fueled optimism that the Federal Reserve could begin cutting interest rates as soon as next month, but there's a problem with that with this PPI report, because what we usually see is that today's producer prices often become tomorrow's consumer prices. So if companies start passing along these increases in their prices, the Fed may have less room to cut rates without reigniting inflation. So why this exactly matters is because when the Federal Reserve wants to cut rates, they want to see inflation low and unemployment low and stable. Now, up until this recent PPI report, we did not really see that crazy of an effect on inflation from these tariffs. And we saw the job market declining, which is an indication for the Federal Reserve to cut rates, assuming that inflation is still low. However, with this uptick in PPI, that means that there's likely going to be some inflation effects that the consumer sees in the CPI reports in the coming months. So that kind of creates a controversial dichotomy there, because the Federal Reserve does not want to cut rates if we start to see a spike in inflation, but they want to cut rates if unemployment is getting too low and unstable. So now we're seeing low and unstable unemployment, and we're seeing rising inflation. So one saying we should cut rates and one saying we shouldn't cut rates. So with companies paying more for these goods, they're going to start passing that along to the consumer, and that means consumer prices will increase. So that means the Federal Reserve will just have less room to cut rates without reigniting inflation. Politically, this is risky territory for Trump and Republicans, because the sales pitch is that foreigners will be paying for the tariffs and that foreign governments that have been ripping us off for years will be covering this. But we know that that's not the case. We know that the data proves that Americans end up paying a bigger share for those tariffs, American companies, and then more specifically American consumers, because companies like to maintain their profit margins and pass those higher prices on to their consumers. So ultimately, at the end of the day, consumers either directly or indirectly pay these higher prices, and it just means they pay for a higher shelf price, or there is slower business investment and weaker wage growth. So either way, it affects the consumer dramatically. We know that real wage numbers are not helping this narrative either. Inflation-adjusted average hourly earnings rose just 0.1% in July after being completely flat in June, and they're only up 1.2% over the past year. That's not enough to make voters feel wealthier, and it's not enough to combat the rise in PPI that we just saw. And what we just saw is that their cost of living is rising faster in 1 month than their wages are growing in 1 year. Are you seeing the problem yet? Now, I want to end this on a pretty clear note. Tariffs are not inherently inflationary in the sense of money supply unless the Federal Reserve eases monetary policy to accommodate them. But they do raise the prices of targeted goods, and those increases can ripple through the supply chain, essentially replicating monetary inflation effects. This is just a fancy way of saying that the purchasing power of your dollar will go down yet again for another reason. Now, for most voters, this reality check comes from what they see in their paychecks and at the checkout line. So if prices start to climb faster than wages, even temporarily, consumer confidence usually suffers. And if Republicans keep insisting that the economy is thriving while grocery bills, restaurant tabs, and everyday expenses tell a completely different story, as we see through the weekly and monthly data, they could find themselves facing the same political credibility gap that has tripped up Democrats in the past. So long story short, we are seeing an interesting story pan out. We thought we were going to have guaranteed rate cuts going into into the end of this year because inflation was low and we were starting to seeing a dip in unemployment. However, we know that's not the case now. We are seeing inflation tick up while the labor market is still weak, and that's just going to complicate things moving forward. So all we can do is sit here, continue to monitor the data that comes in, and adjust our view as we go. As always, I will continue to keep you guys posted in the future videos. So if you guys like this type of content, make sure to leave a like, drop a comment, let me know your thoughts, and subscribe so you can stay up to date for more videos like this in the future. See you guys in the next video. Peace.